Hello and welcome to our recap of non-current assets IAS 16 and impairment IAS 36. So looking at IAS 16, first of all, non-current assets, what are we talking about? Well, they need to be tangible, i.e. you can kick it, you can touch it. It's going to be used for several periods, so it's held for use in production, supply or administration. So we're going to use it for several years, so we're going to capitalise it. When can we recognise it, i.e. capitalise it? Well, when it's going to give us probable future economic benefit, we're going to earn some money from it, and that cost of that asset can be reliably measured. So that's going to be the amount that we paid for it. Let's look at that in more detail when we look at how to measure it. So the initial cost of the asset, well, we can bring in the purchase price and any direct costs in bringing the asset to use. We can also bring in restoration costs, for example, if we need to dismantle the asset at the end of its useful economic life. However, we cannot bring in the initial cost admin costs, general overheads, post-production costs, initial losses or any abnormal losses. So we're not allowed to capitalise any of those costs. We can also bring in future expenditure. We can capitalise that if it increases the economic benefit in excess of the original we expected. So if it's just maintenance to keep it at its original amount, that's not going to be capitalised. But if we improve the asset to get more economic benefit, well then we can capitalise that. And we looked at that in illustration 1. We then have a subsequent choice when it comes to our assets. We can hold them at cost less depreciation or under the revaluation model. So the revaluation model will be revalued amount less depreciation. So that will be fair value less depreciation. We need to have regular revaluations, and if we revalue one asset in a particular class, for example buildings, we need to revalue them all in that class, all of the buildings. So if we do this revaluation, if we revalue upwards, well, what we do is we restate the asset to the new value. The difference between the carrying amount and the new value will go to a revaluation reserve and be shown in other comprehensive income. Obviously, the existing depreciation is therefore removed. Revaluation downwards is an impairment, which we'll look at in detail shortly. That will go to the profit and loss account. So we revalue downwards to the profit and loss account unless we had a previous increase that was in reserves. In that case, we remove that first of all. So remove that first of all and then to profit and loss. And we then calculate our depreciation based on the revalued amount. Do be aware of what's called a transfer in reserves. So if a company chooses to make a transfer in reserves, that's a transfer from the revaluation reserve to ordinary reserves for extra depreciation. So we transfer an amount from our revaluation reserve to ordinary reserves each year to allow for the extra depreciation on the revalued amount. The amount will be the depreciation calculated on the revalued amount less the depreciation on historic cost. So the depreciation before you revalued the asset. The difference between those two is transferred from reserves, from our revaluation reserve into retained earnings. So we did that in illustration 2. When we look at depreciation, remember, how do we depreciate? Well, the pattern of economic benefit is the key here. How do we expect to use the asset and how long for? When do we start depreciating? Well, we do that when the asset is available for use until it's derecognised. Remember, it's going to be based on either the historic amount or the revalued amount. So the depreciation will be based on either of those depending on what we've chosen. We need to review annually, number 1, the residual value we expect, number 2, the useful life of the asset, and number 3, the depreciation method. And remember, if we need to adjust any of those, that will be under IAS 8, a change in accounting estimate. So we don't restate previous years, we simply do it moving forward. We also learned that for major components, if they're replaced regularly, we depreciate them separately. So if they've got different components in a large asset, we'll depreciate those separately and capitalise any replacement cost. And again, we did that in illustration 3. We then moved on to look at IAS 36, impairment. What was this? Well, this was when the recoverable amount was less than our carrying amount. So the carrying amount of an asset, for example, exceeds the recoverable amount. So the carrying amount of the asset exceeds what we could get for it. So what does this mean? Well, each year we need to do this review, but we only do it for two specific assets. We review the carrying amount compared to the recoverable amount on goodwill or any intangible assets with indefinite lives that we have. So other than that, we look for indicators of impairment each year. So we review goodwill and intangible assets with an indefinite life each year. But otherwise, we look for indicators of impairment on our other assets. Indicators would be restructuring, increases in interest rates, fall in the market value of a share, for example, loss of key staff or losses in the business, environmental changes, particularly in the business environment, or damaged assets. If we see any of those indicators, then on that asset we need to compare the carrying value to the recoverable amount, which is an impairment test. So as I said, our impairment test will be to compare our carrying amount to our recoverable amount. And we need to know that to calculate the recoverable amount, we compare the higher of the fair value less cost to sell and the value in use. So we compare those two and use the higher as our recoverable amount, and that's the value in use in the current state of the asset without any improvements. So we did that in illustration 4. Looking at the detail, the fair value less cost to sell will be the fair value in an active market or if you have a binding sale agreement, but basically using the best information that you have. When it comes to the cost to sell, well, the selling costs you can bring in here are legal costs or taxes, but not redundancy costs. When it comes to value in use, the value in use will be the present value of the future cash flows, discounted at a suitable discount rate over 5 years. So we did a detailed illustration of that in illustration 5 to compare the two of those. So that's our impairment test. We compare the carrying amount to the recoverable amount to see if there's an impairment. What do we then do? Well, remember, the impairment will be on what's called a cash generating unit because we needed to get the value in use, which needed cash flows. So that's the smallest group of assets that has its own income stream. So looking at that cash generating unit to allocate the impairment, we allocate it first of all to any damaged asset. So if there's a specific damaged asset, it will be written down in value first of all. We then wrote down the value of goodwill, if we still had some impairment to use up. And if we'd written off our goodwill but still had some impairment to use up, we allocated it to the other assets pro rata. Do be aware that we can't write any assets down to less than the higher of fair value, the value in use, or 0. So we can only write assets down to the higher of its fair value, value in use, or 0. And we did that in illustration 6. Remember, looking at an individual asset, if it was revalued upwards previously, we use up the revaluation first, then any impairment goes to the profit and loss account. We then calculate our depreciation based on the recoverable amount. Can we reverse an impairment? Well, yes, we'll review it each year to see if we need to reverse it. If we do, we'll reinstate the revaluation reserve first of all, and then to the profit and loss account with the amount that went there. We can't revalue though upwards to more than the value if there had been no impairment at all. So we cannot revalue to upwards of what historic cost would have been. And also we cannot reverse an impairment of goodwill. So we can reverse an impairment on other assets, but not on goodwill. So that was a recap of our lecture on IAS 16 and IAS 36.